Hello, and welcome to Virtual Investor Conferences. My name is Matt Leteplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from PineCliff Energy Limited. Please note, you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Scheduled Meetings tab found on the conference platform. At this point, I am very pleased to welcome Chris Zach, VP of Finance, and Philip Hodge, President and CEO of PineCliff Energy Limited, which trades on the OTCQX Best Market under the symbol PIFYF and on the TSX under the symbol PNE. Welcome back, Chris and Philip.
Thank you very much, Matt. Appreciate it. Happy to be here again with the OTC group. We had some very good responses last time, and have made a lot of new friends and shareholders since the last time we presented to this group. So hopefully we can make some more today. We will get through the presentation. Like I said, as Matt said, please pass your questions along. We'll either deal with them as we're going through the presentation if they're relevant on any given slides, or we'll deal with them at the end. So let's get through the presentation here. We start off kind of with the main reasons you'd want to own PineCliff. But the one thing I'll stop and give you just a real brief background on PineCliff for those of you who don't know our story. And I know that there'll be many of you who already do know it, so I won't go in great depth. But this is now our 13th year that we've been operating PineCliff. I was employee number one back in 2012. The model has never altered. The goal was always to build a dividend paying company off of low decline natural gas assets as the primary kind of piece to the asset portfolio. And so we've gone from when I started as employee number one, we had 100 barrels a day of production. Today we're over 25,000 barrels a day of production. So we've done significant transactions along the way, including one that we just finished a couple months ago in December, which we'll talk about in a couple minutes here, the Certus acquisition. Like I said, if you would have heard the presentation at any point in the last 12 years, it would have been very consistent with what you'll hear today. We've always believed that this type of model would be an investment vehicle that would be well received by high net worth retail investors with family offices and with institutions that were looking for exposure to natural gas, but also wanted to be, as we say, paid while they wait. And so we're very disciplined in all of the acquisitions that we've done. That's, to us, the biggest part of our job is capital allocation, and that's the part we spend the most time on. The one thing that has helped that discipline is that we've always had a high insider ownership. I'm a significant shareholder in PineCliff. I've never sold a share. I've been buying more shares as recently as last week, as has Chris, who joined us in September. And the reason for that is because we really believe that now is a very good entry point to come in on a natural gas producer in Western Canada, which is what PineCliff is. We have the lowest production decline rate of any public company in all of Canada. We'll show you a slide on that. And we've also got one of the highest exposures to AECO natural gas. For those who aren't familiar with AECO is just like a Henry Hub or NYMEX, but it's the Alberta hub. And why that's relevant is we'll talk about, but we really think Alberta is going to be a very attractive place in the upcoming years for natural gas for a variety of reasons. I mentioned the high insider ownership. We also, one of the biggest institutions in all of Canada is the Alberta Investment Management Co. They manage about $140 billion, I believe. And they own over 10% of our company. And then Insiders Management also owns another 4% of the company. So we're very, we like to run the company as if it was almost like a private company that happens to be public. And we think that drives the right kind of decision making. I'll go fairly quickly through this presentation, but this presentation is the exact same presentation that's on our website. So I would encourage you to go to the website. You can also, while I've got you here, you should, if you haven't signed up for my quarterly emails, I'd encourage you to. We've got quite a distribution list now that people that like to see our quarterly updates, which are really focused on the macro around natural gas and less so on PineCliff. Here's a snapshot of PineCliff. We're about these are all Canadian dollars, about $350 million market cap, which would make us over a $400 million enterprise value. We've got these. You can see that the liquidity has been pretty good. I mean, we've had higher liquidity in the past, but we typically trade around 500,000 shares a day on all the various type of the exchanges. We'll talk about our guidance on our and where we're at with our budget for the year. This is a slide just quickly talks about the Certus acquisition that we did. As you can see, it's quite close to our main central Alberta assets. Almost all of our assets in Pinecliff are located in the province of Alberta. There is a little bit in Saskatchewan, but again, we'll talk about why we think that's a pretty good jurisdiction to be operating in. So the Certus transaction was a little over $108 million transaction. That was the second biggest transaction we've ever done in our history. What's relevant to you as potential investors is that we did that transaction without issuing any stock whatsoever. Matter of fact, we've done the last two purchases without issuing any stock. The last deal we did was before this one was December of 21. So we went 2 years without doing any deals, even though we've grown by acquisition. I'll talk about that in a second, because 2022 was a fantastic year for cash flow, but it was not a great year for doing acquisitions because the expectations of the sellers had risen with the commodity prices. This is our budget for 2024. You can see that it's about total capex of $17.5 million. What's relevant there is a couple points. One is that in 2023, our budget for capex was about close to $30 million. So we reduced it in 2024. Again, that earlier comment I made about running it like a private company, we don't think bringing on any gas molecules in 2024 makes a lot of sense. We think that gas prices are going to be constructively higher going forward after 2025 for a variety of reasons. And in 2024, because we just came off the warmest winter in recorded history for Northern Hemisphere, that the demand was quite low for home heating, and that has impacted the storage levels for natural gas. So storage levels are a little higher than what we've seen in the past, but we think they're very tight markets, and therefore you can have a quick drawdown. In the meantime, our view is to slow down the drilling for 2024. That CapEx number, by the way, is an all-in CapEx number. That includes our abandonment and reclamation, which is about $7 million. We've got about between $4 and $5 million of maintenance capital also built into there. And then the remainder would be for drilling or for recompletion work that we would do, none of which we're doing in the first half of the year, other than some third-party wells that are being drilled that we have a small working interest in. As I mentioned, our production guidance is between 24 and 25,000 BOE a day. And our dividend right now is about 6 cents a share, which is over 6% dividend yield. So pretty significant dividend yield, even after we adjusted to take in the fact that we think 2024 is going to be a more volatile year. But we're pretty happy with what we see going forward. We really think that 2025 and beyond could look a lot more like 2022. The one nice thing I like about Pinecliff for investors who are coming in and it's a very different model. Pinecliff there is no other Canadian public company that kind of runs the business like we do, with the really low decline and with the high payout ratio. But what I like is that in 2019, 2020, we saw the worst gas prices in Western Canada in about 30 years, and yet we still had positive cash flow. That's pretty significant. And that was even before we had added some more oil and NGLs exposure, was in what we did in both the transaction at the end of 21 and in the transaction at the end of 23. So you can see that what happened is that in 2021, we had the best year in our 10-year history at $59 million of cash flow. But then 2022 happened when gas markets were quite tight again, and therefore prices rose significantly. So we averaged about $5 AECO during 2022, and we did $163 million of cash flow. More significantly, we did about $55 million of cash flow in one single quarter. So we almost matched our best year ever in one quarter in 22. 23 was very, very similar to 21. Gas prices were weaker, but oil and natural gas liquids were pricing was higher, and that allowed our revenue to rise. 24 right now is feeling a lot like 2023. We're kind of right now forecasting on forward strip around the same level of cash flow. So that was the reason that we adjusted the dividend. And you can, there's a webcast that's on our webpage that you can listen to, is where we talk about the dividend and the adjustment we made coming out of the year. It just didn't make sense for us to continue with a 100% payout ratio. For us, I don't want to use debt to keep the dividend. And so we think of the dividend as a variable dividend. We've put it in place in 2022 when things were very strong. In 2022, just for give you a bit of background, we went from $50 million of debt to $50 million of cash flow within 12 months. That was the same time that we put the dividend in place. So the dividend's been in place now since almost, not quite 2 years, and we've already paid over $70 million in dividends. That's pretty significant given the size of our entity. One of the questions that I've already received from you, and again, we encourage you to put your questions in, and I'll deal with them at the end of the presentation, is about our sensitivity to oil. And we're about 79% of our production is gas, but the oil and NGLs is making up probably about 45 to 50% of our cash flow right now. So it's not insignificant. We have a good size oil company within Pine Cliff. We've got about a little over 5,000 barrels a day of oil and NGLs within our production base. So that's you can see that it's about, for every dollar change in WTI, it's about $1 million cash flow change to Pine Cliff. And on the AECO side, about every 10-cent change in AECO is about $3 million of cash flow sensitivity. So what you can see is that this extra cash flow that we're generating. So right now on forward strip, what these slides are meant to show you is how much extra cash flow do we have after the dividend, after the CapEx. And you can see in 2024 that we're generating at forward strip with just under $10 million of extra free cash flow for discretionary cash flow to pay down debt or to do any acquisitions. But you can see quickly how fast that number rises. And that'll be, I think one of the questions, another question that I received is how do we think about the dividend increases? I mean, we increased it twice, and then we decreased it once. I think as we continue to see more cash flow, and therefore our payout ratio will decline in percentage to less than 80%, kind of where it's at today. I think that'll be the time that we think about, okay, now from a capital allocation standpoint, do we want to increase the dividend? Do we want to pay down the debt further? Is there any acquisitions that make sense? We have not traditionally looked at share buybacks. I'm not saying we'll never look at share buybacks, but from our perspective, because we have a lot of insider, fairly high ownership, we're a little worried about liquidity. We keep an eye on that, but it's actually, like I said, improved considerably over the years. The other second thing we look at is, can we buy assets cheaper than what our own stock is trading at? And that's been the case for the last 12 years. That could change going forward, but right now that's been the case. And so we'll continue to monitor that quite closely. This is kind of our hedging, part of the dividend. We never, in the early years, we didn't hedge at all at Pine Cliff. I think the hedging is an important part for three reasons. One is to either protect your debt levels, so you want to make sure you can repay debt, or you want to protect your CapEx budget, or you want to protect your dividend. For us, the debt right now is about 1 times debt to cash flow. We think that's a very comfortable level, and we're gonna, we could be debt free or close to debt free by the end of 2025, depending on what commodity prices do. But right now, the commodity prices, the forward strip for AECO is already over $3 in the winter of in the next 9 months. So in Q4 and Q1 of 25. I think that's pretty significant, because as we point out that our current break even kind of is around that $1.80 MCF. So if we're getting $3 gas, we're continuing to generate a lot of extra free cash flow. So our hedge profile is around 25%. It's our overall, we kind of think of it roughly 30% of our natural gas and our oil hedged for most of 2024, weighted towards the summer. The one thing that we talked about earlier, and this is this graph really, or this picture really kind of highlights it, is that The average natural gas company in Canada has a 31% decline rate, and that is very significant. You can see that we are, with a 9% decline rate, are significantly lower than all of our natural gas producing peers. And what that means is we just do not have to spend as much money as they do on a percentage of their cash flow. So our CapEx, if we want to keep our production flat, is a much lower threshold, which therefore allows us to be able to give more money back to the shareholders. So that's one of the reasons why I feel comfortable that is in a rising gas environment, which we believe we're heading into, we're going to generate a lot of extra discretionary free cash flow and will not have to spend it back on the drill bit, and therefore be able to share it with our shareholders or do acquisitions. As you can see, we've been one of the fastest growing companies that in the Canadian space and especially on a per share basis, which is really important. For us, it's always on a per share basis. Every transaction we look at is what does it mean to our cash flow, our free cash flow, our production, our reserves, but all on a per share basis, not on an aggregate basis. I'm not going to spend a ton of time on the outlook for natural gas, because you can go through these slides, and many of you already know or already have a view on this. The couple of things I would point out is that I don't think the average investor realizes the fact that natural gas is now the single largest source of energy in the United States. I've got I had 3 articles sent to me this morning from investors pointing out that at CIRA week this in Houston, they were talking about how much energy is being used by AI. One of the stats I saw that it uses that every AI search uses like 6 times as much energy as a Google search. The people are focusing on how much energy needs not only does North America have, but the world have. And I think that's where the U.S. LNG exports really is an important story to tell. I think the ongoing demand. I mentioned earlier that we are coming off the warmest winter in recorded history in the Northern Hemisphere, and yet the U.S. and Alberta, which is our backyard, still had record natural gas demand during that time frame. So we're sitting at very high demand, even when it was an environment, it was quite a warm winter, and therefore the home heating was quite low. But there's so many other demand sources that are happening out there. One of the biggest ones that you're going to hear a lot of people talking about is the LNG. And for good reason, both in Canada and in the United States. The United States in 2016 exported 0 LNG. It now is the world's largest exporter of LNG. Unbelievably growth. It's up to 14 BCF a day. What happened, though, is in 2022 and 2023, we kind of stalled. That first phase of development in LNG was complete. And so then what we are now entering into, starting at the end of this year in 2024, is we start to see that next leg of growth of LNG exports. And that is really important, because we're going to more than double the amount of LNG that's being exported out of North America. And put that in perspective, is that's today there's about 100 BCF a day in the US produced, about 18 BCF a day in Canada. We're talking about moving from 14 BCF a day to over 30 BCF a day. So we're quickly moving to like 25% of all of the gas produced in North America would be exported. In Canada, the LNG Canada project is 2 BCF a day. They've just phase 1, and there's just, the discussion is when will phase 2 get announced, because the pipeline that was built that provides LNG Canada with its gas is this Coastal GasLink pipeline, and it has capacity for 5 BCF a day. The very first phase of LNG Canada is only 2 BCF a day. So without having to build another pipeline, they could more than double LNG Canada exports. That's very significant. Again, all of Canada only produces 18 BCF a day. This is one of the primary reasons why I think being a producer of natural gas in Western Canada is going to be very, very important. And so there's a couple of things that at play. The LNG Canada, and if you're wondering why we think the Canadian LNG is going to be so important to the global picture, is that we've got the quickest access from North America going into the 4 biggest importers of LNG in the world, which are China, Japan, Korea, and Taiwan. It's a 10-day shipping instead of 24-day shipping. And a lot of these other shipping routes are getting impacted, as we all know, in the Red Sea because of what's going on geopolitically. So the ability to be able to have that direct access to the Asian market really is a competitive advantage, both from an emissions and an economic standpoint. The other thing that we really like about Alberta, there's two other pieces I would point out to you. One is this project demand, the project demand graph that we put in here, chart that shows that a half a BCF a day of extra new natural gas demand is happening in Alberta alone in 2024. Alberta used to 80% of all of its energy came from coal, and this will be the very last coal plant shutting down in 2024. So very, very significant, so that's happening. At the same time, there's a diversification projects that are going on for hydrogen, for plastics, for fertilizer, all of which use natural gas as the feedstock. And the biggest single user of natural gas in all of North America is the oil sands. They use close to 3 BCF a day. Again, we only make 18 BCF a day, so they're using a tremendous amount of the gas that's produced in Canada. And they now have the TMX pipeline that's going to allow them to ramp up their production further, because that is going to go from 300,000 barrels a day to 900,000 barrels a day. Why they use so much natural gas is they use the natural gas to heat water to create steam that goes into the ground to allow the bitumen to flow. So there's a variety of reasons why we really believe that things are looking very strong for natural gas in North America, and also specifically in Western Canada. One of the things that really has changed for those of you who have not been investing in the energy sector over the last few years is that historically the energy sector spent more cash flow than it brought in. And this chart here shows that. But what's happened in the last 5 years is there's been a big focus on returning capital to shareholders. And therefore, a lot of the money is going back to shareholders instead of going into the ground. I think that's very healthy, both for shareholders and for the industry itself from a supply standpoint. And so that's something we've always focused on, but it's interesting to see now that the entire industry is focusing on that. One chart, this is kind of an interesting one. I talk about how tight the market is. And this was I know highlighted by the EQT CEO at Sierra this week. He was talking about how there's been no investment in storage capacity, and therefore North American markets are much, much tighter than what people may believe. And I would echo those thoughts, because what's happened is supply and demand of natural gas in North America has increased tremendously, and yet storage hasn't. So what that means is you've got a bigger and bigger engine, if you will, sitting in a car, that's my analogy, with the same size of gas tank. So right now, supply surpassed demand in the short term because of weather, and therefore storage filled up quickly, because these are very big amounts we're talking about. But that can go the other way very quickly, and that's what we saw in the fourth quarter of 2022, when we had some cold weather and market demand was quite a bit higher than supply, and therefore we saw $10 gas prices. I think in what we're heading into is a similar type environment, where we've got demand increasing with LNG exports, with heading into winter. At the same time, supply is dropping off. These low gas prices, we have a sub $2 gas price right now in North America at both NYMEX and in AECO hubs and Henry Hub. What that has done is that many of the biggest producers have cut production. So supply is dropping. Rigs count is dropping. All of that's happening with the backdrop of increasing demand about to kick in later this year. So I think it's going to be a dynamic and continuing to be a volatile sector. The one thing I'll leave you with before we go to some of the questions is that the natural gas demand continues to be the fastest growing hydrocarbon in the world. And I know that people love to focus on the renewables for good reason. It's been very high growth for wind and solar. Much of that's in China and Asia. However, hydrocarbons continues to be over 80% of all of the energy consumed in the world comes from hydrocarbons. And natural gas has got the steepest growth rate. And that's really because of the LNG growth that's happened in the world. I mean, everywhere where natural gas is used, and which is primarily now coming in the form of LNG, it's rising in demand. And we've got, Shell and BP predicting that we're actually going to have an LNG shortage in the back half of this decade, because they're, even with all the expansion LNG that's under construction right now, which we showed, it still isn't going to be enough to deal with the demand. So that is, I raced through that, but I wanted to make sure that we had some time for questions. One of the questions that we've got here is, what is the reason for the lower decline rate than the average natural gas co? That's really been because of the focus that we've had on focusing on adding assets that are already past the steep part of their production curve. So one of the interesting parts of our industry, and why we've had such incredible growth in production supply, is because of technology. So the having to go of much deeper and longer lateral lengths on the horizontal drilling has allowed producers to get much bigger, what we call IP, initial production. But what that means is that they have a much higher decline rate as well. The flush production comes on at a really large amount, but it quickly declines. So from what we've traditionally focused on in our early transactions was getting a lot of assets that already the steep decline production had already happened, but would still be continuing to be very economic wells to manage for decades to come. And we're very proud of that fact. We spend a lot of money every year on our abandonment reclamation on our inactive liabilities. So we have one of the highest ratios in the industry. We're about 92% of all of our non-abandoned wells are active. And so we continue to spend, this year we'll spend another $7 million on doing, we've done about 1,000 abandonments in the last 3 years to be well ahead of the curve. It's all part of the business model. And that's all in our CapEx. So I don't try to hide those numbers. That all goes to the free cash flow. So it really, the Certus deal we just did, that one had a little higher decline. It was about 16%. But they hadn't done much drilling, which we saw as a positive. Oil and NGLs tend to have a little higher decline rate than dry, shallow natural gas. So, but even on a blended rate after the Certus deal, we were under 10%. The next question we have here is how has the integration of Certus been, and what type of assets are you looking for in future? The Certus assets, the production has been very strong. It's been a bit of a challenge because from an operational standpoint, anytime you do a corporate acquisition, you got to get all of their systems, their accounting systems, their land systems, their joint venture systems onto our system. So there's always a bit of a few months there where we have to spend a tremendous amount of work, and I give our team a tremendous amount of kudos and pats on the back for what they've done, because they've really done a yeoman's effort. We're through that now. We're now at the very tail end of that. We're getting all their payables all caught up. We're getting, it is now no longer a Certus asset. It is now a Pine Cliff asset. And so we're pretty proud of how we were able to move that forward. The production was always strong. When we took over those assets, they were about 6,000 barrels a day, and it's not much less than that today. So it's been very high. In the future acquisitions, free cash flow. That's what we look for, free cash flow. And so it can, if it's driven by gas, that's fine. If it's driven by oil, we're agnostic. I think we'll always be a gas-weighted company because we really believe that that's going to be where we have the greatest potential to generate excess free cash flow to our shareholders. But it's all about, again, free cash flow. And as an investor, that's what I would always look for, is free cash flow. I don't, it's one thing to say what your cash flow is, but if your costs are eating up all your cash flow, then that means you don't have extra cash to send back to the shareholders. And that's what we focus on. It's always on a per share basis. Another question was on the target dividend payout ratio for 24. Very good. We think about this a lot. So the reason we reduced the dividend back in the early part of this month was because our payout ratio was around 100%. For those who aren't familiar, payout ratio just means that after all of our costs, after all of our CapEx, and after the dividend, is it more than our actual cash flow? And it was. So I didn't want to use debt to maintain the dividend. And we've always said we weren't going to use debt to maintain the dividend. So that was the biggest reason why right now it's between depending on any given day on spot prices, but it's between 80 and 85% of our payout ratio is covered off. So we're comfortable at that level. As cash flow rises, that payout ratio will drop. And therefore that opens up the possibility for more capital allocation decisions. And so that would include the potential for raising our dividend again. So, hopefully this is a topic we're having in later this year or in early next year. If we got excess free cash flow, we want to know what we want to do with it. And I think we can really make a point of looking back at the dividend and treat it like a variable dividend, and that we've raised it twice, we've reduced it once. Hopefully the next moves will be reducing or moving it even higher with the free cash flow. Quickly, we've got a couple seconds left here. The PNE, the shut-in price, it varies by assets. One of the questions was how much does gas have shut in due to the lower price? Right now, we have no shut-in gas. We've hedged forward our production, and so we're in a very good position on that front. If gas prices were to continue to drop through the summer, we have in the past shut in production, but it was back in 2019, 2020. Right now, it doesn't look like we'll have any of that issues because of the hedge production and because the forward strip for the summer has actually been improving here over the last few weeks. Thank you very much. I would encourage everyone to go to our presentation on the website. If you haven't signed up for the quarterly updates, please do so. And if you've got any further questions that I didn't get to, please send them to us directly and we'd be happy to address them.